Fed on their own is still, generally speaking, a reducer of net liquidity. And it's really been, for the most part, the Treasury that has been offsetting this.
Mm.
But of course, they can only do that until the reverse repo facility is run out. And at this point, it's got about, $500 billion left in it. And so they've kind of tapped into three-quarters of it. There's still another quarter that can go into the system. And at that point, we probably would start to see the Federal Reserve stop their quantitative tightening and start to go to maybe a more neutral liquidity situation. But that's kind of a thing we have to navigate as we get closer to that time. The other big factor is global liquidity, which takes into account all those types of factors I just mentioned. But then the other big factor is how strong is the dollar compared to other major currencies. And the reason that's relevant is because a lot of entities around the world, both sovereign governments and corporations in different governments, have debt denominated in dollars. And for the most part, it's not even owed to the United States, it's owed to other countries. For example, a country will owe dollars to China, they'll owe dollars to a lender in France, they'll owe dollars to a lender in Japan, for example. There's this interconnected web of assets and debt out there, and a lot of it is dollar denominated.
In a recent analysis by Lyn Alden, a prominent finance expert, she delves into the intricate dynamics shaping the US economy, particularly focusing on liquidity trends and global equity. Alden highlights a pivotal shift in domestic liquidity since late 2022, with the Treasury injecting liquidity back into the system, offsetting the Fed's quantitative tightening measures. However, looming concerns arise regarding the sustainability of this liquidity as the reverse repo facility nears depletion. Furthermore, Alden underscores the impact of a strong dollar on global liquidity, complicating the scenario for indebted entities worldwide. With the US dollar maintaining its strength, the potential for a currency crisis looms, posing challenges for the global financial landscape.
There's domestic liquidity and then there's the broader picture of global liquidity. So if we focus on domestic liquidity,
Mhm.
throughout much of 2022, for example, we had declining liquidity. The Fed was doing quantitative tightening, and so they're reducing the amount of base money in the system. The Treasury was not offsetting that, so you had overall net declining liquidity. Starting in late 2022, the Treasury started to provide liquidity back into the system. At first, they were doing it by drawing down their cash balance, their Treasury general account. They were pushing cash into the system, and they did that, largely due to the debt ceiling issue at the time. And then after that period resolved by mid 2023, they instead started pushing liquidity into the system from the reverse repo facility. So there's a lot of jargon there, but basically the reverse repo facility was this pocket of about $2 trillion worth of excess liquidity that was built up during the pandemic stimulus. So during the Fed's really fast rate of QE, they basically flooded the system with so much cash, and a lot of that cash kind of poured into this reverse repo facility. And there's a lot of reasons for that we don't have to go into right now. And that was basically dead capital. It's kind of stuck out there. It's outside of the financial system, and the Treasury tapped into it by shortening their average debt duration. So instead of issuing, for example, a lot of 10-year treasuries, they would issue a lot of 3-month T-bills, for example. And that allows them to kind of tap into that reverse repo facility and start pulling some of that $2 trillion out of that, kind of dead pocket of liquidity and back into the financial system. And so the real story since late 2022, so going on almost a year and a half now, is that while the Fed continues to be relatively tight, the Treasury has been positive for liquidity. They've been pushing liquidity into the system in various ways, and so we've kind of been in this flattish liquidity environment, flat to up, in fact, for ever since that time. And the Fed, for their part, so during the March 2023 banking crisis, the Bank Term Funding Program, it was a net liquidity injection, but since then they've offset that by continuing to do quantitative tightening. So the Fed on their own is still, generally speaking, a reducer of net liquidity. And it's really been, for the most part, the Treasury that has been offsetting this.
Mm.
But of course, they can only do that until the reverse repo facility is run out. And at this point, it's got about, $500 billion left in it. And so they've kind of tapped into three-quarters of it. There's still another quarter that can go into the system. And at that point, we probably would start to see the Federal Reserve stop their quantitative tightening and start to go to maybe a more neutral liquidity situation. But that's kind of a thing we have to navigate as we get closer to that time. The other big factor is global liquidity, which takes into account all those types of factors I just mentioned. But then the other big factor is how strong is the dollar compared to other major currencies. And the reason that's relevant is because a lot of entities around the world, both sovereign governments and corporations in different governments, have debt denominated in dollars. And for the most part, it's not even owed to the United States, it's owed to other countries. For example, a country will owe dollars to China, they'll owe dollars to a lender in France, they'll owe dollars to a lender in Japan, for example. There's this interconnected web of assets and debt out there, and a lot of it is dollar denominated. And so if the dollar strengthens relative to other currencies, it means that their debts are appreciating compared to their
Mm-hmm.
cash flows. On the other hand, if the dollar weakens compared to other major currencies, their debts shrink relative to their cash flows, which is good for liquidity. And so right now, the dollar is relatively strong, which is somewhat keeping a lid on global liquidity by keeping all these indebted foreign entities relatively pressured. And so it's kind of a mixed bag overall for global liquidity.
Continuing the discussion, Lyn Alden delves deeper into the intricate interplay between fiscal deficits, bank lending, and inflationary pressures within the U.S. economy. Alden delineates the distinct roles of the Federal Reserve's balance sheet size and interest rate policies in managing liquidity and influencing bank lending rates. She emphasizes the challenge faced by the Fed in navigating a landscape where fiscal deficits stimulate inflationary pressures, while traditional monetary policy tools struggle to directly address the underlying fiscal imbalances. Drawing parallels to historical analogues, particularly the 1940s in the UK, Alden underscores the unique complexities of the current economic scenario. With potential signs of inflation re-acceleration on the horizon, she advises a cautious approach to investment strategies, highlighting energy as a potentially resilient asset class amidst market uncertainties.
So I treat the balance sheet size and interest rates as pretty separate categories
Mm-hmm.
because one is more about liquidity and one is more about trying to increase or decrease the rate of bank lending.
Mm-hmm.
Um, and so basically, as all these fiscal deficits pour into the economy, that's stimulatory and it's inflationary. And so the Fed's main tools for controlling inflation are different tools that can determine how much banks are likely to lend. So if they lower interest rates, everybody wants to
Mm-hmm.
borrow debt. If they raise interest rates, people are obviously more hesitant about borrowing. They also have to then consider what the bank's going to want to do. Are they going to want to lend at low interest rates or higher interest rates? But right now, they're trying to slow down bank lending, and it's been relatively successful, but that's offset by the fact that there's so much fiscal deficits
Mm-hmm.
pouring into the economy. And so I think their issue is that their interest rate tools are just not very effective for what they're trying
Mm-hmm.
to do. They can only indirectly address the problem. They can't directly address the problem, which is largely a fiscal situation. Um, and so I think they're more in a holding pattern now. Trying to predict what 12 humans are going to decide later this year is not really something I focus on too heavily. I think that the more that CPI prints come in hot, and the more we're seeing early signs of potential reacceleration of inflation and reacceleration of manufacturing. And should that continue, that will probably cause the Fed to be a little bit more hawkish than the market expects. On the other hand, if some of that data, kind of decreases somewhat, we probably would expect get back on track towards those rate cuts. But the separate factor is their balance sheet, and I think that's largely going to be determined by the liquidity of the Treasury market, more so than inflation. So, for example, back in 2019, there was something called the repo rate spike. Which is where the repo market, basically the rate that different financial entities lend to each other overnight, that blew out. And the Fed had to come in and fix it. And then, moreover, they had to stop reducing their balance sheet. So back then, they were doing quantitative tightening, and they had to stop doing quantitative tightening. They actually had to shift towards doing kind of slow amounts of QE. And that was all shortly before the pandemic. That wasn't a response to it. That was all kind of their own fiscal dominance liquidity issue. So I think that their balance sheet reduction is going to be less determined by inflation and more about the treasury market or the repo market and things like that. Should there be an acute liquidity problem in the system, they would be practically forced to come in and put that fire out. with their balance sheet. And I think that that's what largely determines when they, say they run out of the reverse repos and they get to a point where they're unable to keep doing QT without causing some of those types of problems. And then they shift to a more flat balance sheet or a mildly upward balance sheet, kind of regardless of what CPI is doing at that time. Historical analogs are useful. But people can't assume that it's going to play out just like this period. Someone could say just like the 70s or just like the 40s or just like the dot-com bubble. Each one has certain similarities that we can learn from. Like, for example, whether it's fiscal driven inflation or lending driven inflation, asset bubbles in the past, periods of lower rates or higher rates, what happens when public debt is at this level, what historical analogs do we have? Those are all very useful, but every situation is unique. So I generally find that the 40s are the closest analog.
Mm.
If anything, the 1940s in the UK are the closest analog to the United
Mm.
States today, which is basically you're the incumbent power, you've built up a lot of debt, you have a structural trade deficit, and you're now entering kind of fiscal dominance, which is that the large fiscal deficits are a larger force on the economy than bank lending. And so that's really where I view the United States being in today. On average, I expect relatively sticky inflation above the Fed's target. I expect there's big tail risks we could see from geopolitical events that it's hard to model in advance. But if anything, they're more likely to surprise in the worst direction than the better direction. Basically, there's more things that can go wrong that go right in many ways. So that's all a risk for supply chain disruptions, energy disruptions that should be kind of factored into potential valuation analysis. We're seeing early signs of reacceleration. So, for example, purchasing managed indices, conference board leading indicators, these various kind of rate of change estimates for the economy, they were falling throughout late 2021, all through 2022 and 2023. They started to flatline around kind of the second half of 2023, and we're seeing early signs that they might be turning back up. You might be seeing a reacceleration of inflation, a reacceleration of manufacturing, that the fiscal side might be kind of taking over compared to the tighter monetary side. And if that occurs, then I think there are interesting investments that are available in the energy space, for example. Energy kind of been this thing where in 2022 it was a good investment, most other things were bad. In 2023, energy cooled off while other things resurged. And I generally continue to like that energy lack of correlation to other assets. So if someone's concerned about, say tech stocks falling, for example, there's really two main ways that that can happen. One is that their earnings fall short, that the economy weakens, that their tech adoption does not take off as quickly as possible. But the other one is valuations. So for example, if energy price spikes, or if inflation kind of reaccelerates and the market price isn't higher for longer, and says, okay, what about 5% interest rates or 6% interest rates for longer? Then suddenly the valuations of some of those tech stocks can be pressured, while some of these other things can hold up pretty well, like energy stocks, for example. And so I'm not trying to predict too much what's going to happen in any sort of 6-month or 12-month period, but given that early sign of reacceleration, and seeing how crowded the market is into tech names and how it's completely uninterested in energy names, I prefer that kind of risk-adjusted area at this time, at least for an overweight position in a portfolio, not like an all-in strategy, but
Mm-hmm.
basically saying that I like to protect my more disinflationary assets with those other assets like energy that do better in that more inflationary environment.
Today, we dove into the complexities of domestic liquidity, global equity, and the intricate dance between fiscal deficits and monetary policy with insights from Lyn Alden. We learned about the Treasury's role in injecting liquidity back into the system and the potential implications of a strong dollar on global liquidity. Alden also highlighted the unique challenges faced by the Federal Reserve in managing inflationary pressures amidst fiscal dominance. As always, staying informed is key to navigating the ever-evolving financial landscape. If you found this discussion valuable, don't forget to subscribe to our channel for more insightful content.